He's a businessman. He's been running his business in a few unethical ways, and now he's running the most powerful country in the world. So do you really think that he's going to be focusing on global policies that don't actually benefit him?
Officially, he has distanced himself from his companies. We see that in reality, he has not, because he nominated other members of his family to run the companies.
I think that other parts of the world will start advancing faster. I think that talent will flow less into the United States and will shift more into Europe and Asia.
He's pretending to deliver on his promises through what I would call also the entertainment presidency, but he is not delivering what the people asked for.
Let's introduce our panelists. So starting out with HSBC's John Flint, Head of Retail Banking. I'd like to ask our panelists to join us on the stage here. John Flint, thank you very much for joining us. Thank you. Denis Duverne, who's the chairman of AXA of France. And last but not least, Mr. Martin Blessing, who is from UBS Switzerland. Thank you very much for joining us. So we're now into our second part of the disruptive cycle and what it means for the finance industry, which is also where some of the fireworks are really kicking off. You could hear there the younger generation's changing view of the banking system, and what the consumer expects really is changing these days. That's changing the regulatory framework and so on and so forth. So the big question is, what's our relationship with our money and our banks likely to look like in 5, 10, 50 years from now? So I'm going to start out by asking our panelists what you think about that. And John Flint is Head of Retail Banking at HSBC, which I must say, anecdotally, especially on the high streets of the UK, has become one of the most digitised banks. Where do you see it going?
Yeah, look, I think it's a fascinating subject, and I think when we talk about disruption in financial services, we're actually talking about the potential for disruption. There's been very limited actual disruption to date. Revenue pools remain where they were 5, 10 years ago. Customers remain where they were 5 or 10 years ago. I think we are seeing disruption in two ways. New technology is bringing increased transparency across everything we do, which is leading to margin compression or price compression. So we're seeing that disruptive force across our industry. And the other lens through which you can see disruption taking place is through the workforce. In the piece of HSBC that I'm responsible for, roughly 25% of the workforce have been shared over the last 6 years to do the same thing, the same number of customers, the same fundamental activities, with 1 in 4 people leaving the workforce. So that's been the impact of disruption. But the revenue pools, as I said, remain the same in the hands of the same incumbents. And the customers have not yet been disrupted. So the debate is really all about the potential for disruption. And let's be clear, the potential for disruption is very, very significant. But if we get to the kind of where the debate often crystallizes is incumbents versus disruptors, we've got to be realistic. And we've just spent the last decade reinforcing the banking system, putting bigger buffers in. Society decided that we couldn't think of a better way to do this, so we'll keep it going. We'll just put bigger buffers in. The regulators, the grown-ups, they are not going to allow that model to be disrupted in a disorderly way. So the challenge is for the incumbents to figure out how to use new technology to better serve their customers, and it's an urgent challenge. Hence the Tech Advisory Board that was helpfully referenced before we came on stage. And for the disruptors, their challenge is to figure out the realities of regulation and what it means to actually be a bank and to look after other people's money and to engage.
So Martin Blessing, here from the Swiss point of view, and also UBS, which is very well known for wealth management, taking out the human person who you're talking to when you're talking about your money, how will that change the relationship between the person who puts their money in the bank and the bank?
Well, I think what will change is certain interaction with customers where you can use a lot of technology to be faster, better. But I guess that in transactions that don't happen that often, where you don't have a repetitive learning experience, and where you need trust, a lot of people still want to see the human person they're dealing with. And that happens if you do a mortgage. You do a mortgage only once or twice in your life, or it happens when you basically want to invest significantly for your future, or you're a wealthy client and you want to invest your money. You want to know who is dealing with the financial needs you're having. So what we need to find is a model where you combine all these modern technologies, make easy access with human interface, make our client advisors better equipped, know more about the customer, but still have the advisor as a very important interaction point with the client.
When we're talking about sort of staffing levels and cost levels and so on and so forth, where's that ratio going to settle, do you think, instinctively?
I don't know. I mean, we heard on the earlier panel also the question, will technology change the workforce, what the workforce needs and the size of the workforce? If I look at the overall people employed, for example, in banking in Switzerland, I think it's over 100,000. And my guess would be that the number will go down over the next 10 years. I don't know by what percentage. But we see, of course, today that clients are coming less frequently to our branches and that they do a lot of interaction which needed the support of client advisors in earlier days don't happen anymore in the future just because it's more convenient. But sometimes the debate actually today about technology reminds me about a debate I had in the early 80s with my father, who then said, well, I don't know whether we should put cash machines in the entrance hall of a branch because it will basically keep people from entering the branch and interact. And of course, everybody uses these machines today. It's totally normal. And for the years afterwards, the interaction with the clients even went up. It didn't go down. So a lot of technology will help. It will change the way the workforce interacts. It will change probably the number of the workforce. But we will still see a lot of people working in banking and do client interaction in the future.
So complementary but not competition is the message. Denis Duverne, particularly in the insurance sector, how is disruption going to affect things?
So many of the same effects that you've mentioned for banking are happening in insurance. More price transparency, margin compression. The customers want to interact with us in a different way. They are used to the quality of service that they get from the Apple, Facebooks of this world, and so they expect an instantaneous response. They expect to be served a lot better, and we use those smartphones and applications to improve the service to our customer, to tell them about the status of their claim, to organize appointments remotely, and so on and so forth. So there is a great benefit of technology to the consumers. One element that maybe was not mentioned in the scope of banking is the fact that the landscape of risk is changing. So, for example, everybody is talking about autonomous cars. It's not coming tomorrow, but it's coming, and I will not guess when it becomes really pervasive, but clearly with autonomous cars, you would expect a lot less accidents. So car insurance, which represents 30 to 40% of the total insurance volume worldwide, will shrink. On the other hand, we've talked earlier about climate change. Climate change is making some risk higher. And I mean, in this country or in France or in the UK, people insure their homes. But even in some parts of Europe and beyond Europe, homes are not yet insured. And if climate change becomes more and more impactful as we see it, there is scope for more risk protection in that space. Cyber is another area where 10 years ago, cyber was not really seen as a risk. And all insurers were covering cyber risk as part of liability insurance for companies. Now cyber is becoming a big risk, and it's excluded from traditional liability risk, and you have to get insurance for cyber, and we need to get expertise in that field.
These are very, very big areas. I'm going to deconstruct them a little bit. Let me just home in on the autonomous cars. Monsieur Duverne, forgive me, is it not an understatement to say that the number of insurance premiums will go down? I mean, if cars are driving themselves, will you even need insurance for your car?
So, well, I believe that you will need some insurance around this anyway, because first, one of the issues that autonomous cars have faced, or that the intelligence behind autonomous cars has faced, is that you have dilemmas that are usually resolved by humans, and that machines are not used to dealing. If you have the choice of eating an old person, a young person, which one will you choose? I mean, those kinds of dilemmas, which are kind of horrible dilemmas. But you also have cyber risk around autonomous cars. And there have been, I think, a team in China which disabled the brakes of an autonomous car remotely, and you will continue to need insurance of some sort.
When it comes to cyber risk, and we'll come back to it second in the insurance context, but John Flint, I want to ask you about this, because obviously HSBC is such a huge player, you're so international, and you're so digitized. Companies like yourselves are investing huge amounts in getting online, getting your consumers online at a time when hacking is happening in a more devastating way than ever before.
Yeah. So cyber risk is top of the risk agenda. It's a new and emerging risk dimension that requires the best people to step forward and put their minds to this. And the tech advisory board that one of the young people on the intro comments, on the introductory remarks referred to, is an advisory board of technology specialists that exists to advise the senior executives, but the board of HSBC as well. And cyber risk is one of the areas where we're seeking as much external input as we can take. Now, there's a choice. We can hide under the bed and pretend this isn't going to happen and not participate, and that's a choice clearly we're not going to take. So we're engaging in a meaningful way. It's about protecting our own IT architecture and building the defenses using technology to defend those who want to get in to our data. And there's a lot of work to be done from a behavioral perspective, both with staff and customers as well, because a lot of the vulnerabilities that emerge into the public domain, the vulnerabilities exist in human behavior. So I think it's the new cool area of risk management. It requires as much focus and attention as we can possibly bring to bear on it.
Martin Blessing, this must be an issue for you at UBS as well. I mean, you can do as much as you can on the architecture front, but the reality is that the consumer is also going to be potentially one of the windows of opportunity for a hacker and their behavior.
But if you do all these cyber tests, and we probably in all the banks do that, what we always find is the biggest danger is not the hacking of a consumer, but it's basically the human risk in your own organization, right? The way people handling data, the way people have data stored, or employees have stored data on their devices that they carry around. Politeness. We did a test in our data center, and we had a guy coming there with his badge, opening the door. A lady was running to him, and he was polite, and he basically held the door open for him. She was in, and she was not an employee. So you see all these kind of things of human behavior within your own organization. I think they are still the biggest area of, of concern, where we always have to train and manage that people, when they go away from their desk to wash their hands, do they check out and basically block their machine? These are the kind of risks that we see in the end are at least as important to manage as the external hacking, where you, of course, as large companies, as all three of us are, employ a significant number of people trying to shield the data system from external intrusion.
Let's get back to the issue of disruption, particularly in the financial services sector. And I just want to see whether we can do another one of our live voting sessions. let's see whether we can bring up the question, because it's particularly pertinent to the situation that the financial services sector are facing at the moment. That's right, that's the one we were looking for. What is the best way for industry players to cope with disruption? Is it through mergers and acquisitions, radical cultural transformation, or business remodeling? So could I ask the people in the audience, if you wish to use your St. Gallen Symposium app, you can vote on that. We'll take a look at the results later on. Asking our panelists, first of all, John Flint, do you buy in new technology? Is it mergers, so you don't have to bother coming up with it in-house? And you also don't have the same competition from the FinTech world if you buy into that. Do you remodel your business, or do you really engage in that radical cultural transformation?
Look, I think the biggest challenge is the second one. It's radical cultural transformation. What I mean specifically is it's about the ability to learn. So we're a bank, we're not a technology company. Much as I would love to have invented the iPad, that's not our role and our purpose. So our challenge is to figure out how to become brilliant at using new technology, which sounds straightforward. Banking, when it's done well, is normally done by people who are conservative and cautious and pragmatic and very disciplined. And that's a different mindset to an innovation mindset. So I think that the biggest challenge now, and the attributes that will determine those that will win over those that will perhaps lose, it's about the ability to learn. So for banks, my guess is it's radical cultural transformation.
So that's a challenge, but when it comes to the best way to cope with disruption, you'd still focus on that,
I would cope with that. It's about the ability to learn and adapt, to use new technology.
Right. Denis Duverne, mergers and acquisitions, part of the strategy, what would you pick?
Clearly, M&A is not the solution, because I would say that traditional M&A would be a distraction from the main issue, which is the internal transformation of the company. And FinTech, we collaborate with, we invest in modestly, and we try to replicate what they do with our incubator called Camet. But M&A is not the solution. Radical cultural transformation is clearly the key element. We believe that in the next 5 years, 50% of our workforce will have to have changed job, essentially, and we'll need less people, as the other members of the panel have indicated. We'll need people with a different background. We need people to retrain for different activities, and this is very challenging for all employees, but and probably also for all their managers, who are going to interact in a different way. I mean, we have introduced flex work in our company. For middle managers, flex work is a real challenge because they are used to seeing what their employees do and they want to have them around them. And we tell them, no, but you need to look at what the outcome is. You don't need to be watching over their shoulders. And this is a radical transformation that, I mean, young people coming out of university are used to working like that. Middle managers that are 20 years older have a much harder time coping with that issue. Business remodeling is also going to be quite significant for us. We in our strategy that has been outlined by our CEO, Thomas Wood, last year, we said that we want to move from being a payer of claims to being a partner of our customers. In our industry, if you are taking example of this diminishing activity of motor insurance, you have a claim every 7 years, unusual. In China, it's every year, but in Europe, it's every 7 years. And having contact with the customer every 7 years will not give you any customer intimacy. So you need to build that intimacy in a different way.
Martin Blesson, what would you say is the best way to cope?
I would take radical and combine it with business model remodeling, because I think you need to very radical redesign your business. Mergers and acquisitions will be only the solution for those ones that can't cope with the disruption, because they will be acquired in the end. And cultural transformation, while I see John's point, I think it takes a lot of time, because cultural transformation, my experiences in organization means that you also have to change a lot of people, because the people that have learned to behave in a certain way, it's very difficult to make them behave differently in the future. So it takes a long time. So if you start remodeling your business in a radical way, that will change the way the organization does. If you think about, if you go ahead and say, in 5 years, I don't want to have any printers anymore in my organization because I want to be digital, that I would call radical business remodeling, and that would change significantly the way and you could cope with the disruption.
Well, if most of you have gone for sort of the second option, what do you think your shareholders would go for?
Good question. I think they will look for the returns of what you do and say, well, it's up to you, dear management, to decide if the returns I like, I'll keep you. If you're doing the wrong things and the returns are not there, I'll try another management team.
So some of the other options may well be more palatable, like mergers and acquisitions or business remodeling, because they give results pretty quickly, presumably. Let's start taking some questions from the audience and also on Twitter as well. We have a hand that went up right in the back row. Sir on the right, thank you very much.
Thanks a lot. My name is Josef Kotrba, coming from Czech Republic. And my question is the following. Most of the discussion we've heard was about using technologies as a tool of banking. I fully agree. I'm chairman of Deloitte. We're making nice money on that. Thank you to bankers. But there are also things which are attacking directly the heart of financial sector, taking it away. At this point, various peer-to-peer things are not yet a proper threat. They are more a hobby clubs than business. But what if they become real? And a hint that they might. What about if one of the big social networks starts providing those services because people believe they know each other when they share Facebook profile, even though maybe they don't know each other. Thank you.
John Flint, that's an excellent point, isn't it? Peer-to-peer lending, it's a...
Yeah, so I think two excellent points raised, peer-to-peer and then social networks. Peer-to-peer, I think, will find a niche, but I don't think it will ever expand beyond a niche, for the very simple reason that the financial system is architected to make sure there are buffers between people's savings and then them being deployed into an economy. And peer-to-peer means that the risk is on the man or the woman in the street. And I think there is a space for that, but I think it will be niche. I don't think regulators will allow it to grow too large until it's checked. And we need it to go through the credit cycle. We need that system to be tested. We need people to lose money, and for the peer-to-peer system then to figure out who's accountable, whose fault was it, because the banks won't be anywhere near it. I think with respect to the social network issue, it's a great point, and actually in China, it's already happened. And Ali and Tencent already are, well, particular Tencent and WeChat, they already provide the platform through which most people access their banks. As a bank in China, you can access HSBC through WeChat. We have to be there. Now, it's not quite social peer-to-peer in that sense, but the role of social platforms in integrating financial services, look no further than China, because it's already happened.
Martin Blessing, how concerned would you be about the difference in regulation that fintech companies have versus traditional big banks who've been suffering a lot of regulation since 2008 in the crisis?
Well, fintechs, yes, they like to be lightly regulated, but the moment they start lending or taking deposits, in the end they will become banks and they need to be regulated. And therefore, I think, even though I follow what's happening in the industry very carefully, I believe that we as banks have good chances to basically adapt a lot of these things, because fintechs don't know how to deal with regulation as good as we do. They don't have as many customers as we do, and they don't have gained the trust of the customers over decades as we have. And therefore, we are in a very good situation. I remember one of these panels where we're sitting with a peer-to-peer lending company who was basically telling me they will disrupt us and we will all go away. And after the panel, the guy came up to me and said, Martin, we need funding to grow because we can't get enough savings from the savers to make it happen. And that's exactly what John's saying. There is probably a skepticism about savers, and when they start to lose money, we will see how good these peer-to-peer platforms will survive the first significant downturn in the credit market.
Right, let's take another question. I just want to ask the organisers if at some point it's possible to see the result of that voting, to see what the audience thought about the business remodelling. There we go. So much of the panel actually agreed with much of the panel, really. As you can see here, radical and cultural transformation, closely followed, I must say, though, by business remodelling, which wasn't necessarily your favourite. John Flint. Question over there in the back, please, if you keep your hand raised. Thanks.
My name is Oliver Marchand. I'm the founder of Carbon Delta. And we've talked about scenarios, and I'm sure you look at scenarios as well. And I guess the most famous scenario right now is the 2-degree scenario, right? So I'm wondering, how is the financial sector preparing for a 2-degree scenario?
Denis Duverne.
Yes, for us, we have a big balance sheet, which is characterizing most financial institutions. And insurance companies insure their customers against various risk, but we also have to invest our assets. So we look at the 2-degree scenario, both as far as the asset side of our balance sheet is concerned, as well as the liability side. On the asset side, we've decided 2 years ago to divest from coal. And we are very much focused on the risk of what is now called stranded assets. We invest for the very long term, and we want to make sure that the assets in which we've invested, that we are going to hold on our balance sheet for decades, will still be worth what our customers, our policyholders, ask us to pay in multiple decades. So we are very focused on that on the asset side. We are also very focused on that on the liability side, because we take risk of insuring the liabilities of our customers. We see the risk. We see the major catastrophes increasing in number, in frequency, in cost. The population goes to live on the coasts. The sums insured increase with GDP or slightly higher than GDP, because as people become wealthier, they are more conscious of the risk and they want to insure them more. And so that's really part of our life.
Let's take another question from the audience. Right at the back, if you could keep your hand raised, please.
Rainer Lampe from Frankfurt, Germany. If we talk about 2025, and if we assume that your companies will have lost 40 to 50% of your workforce, where do you see your customers being able to pay for your services? Where are you going to create the jobs to pay for that? I would like to see your company's contributions to that.
Let's give you all a chance to answer to that. John Flint, do you want
can we just clarify the question? So you'd like to see us pay for what? The cost of the unemployment?
No, your customers need to pay for your services.
Yeah. Yes.
And where will the customers be able to generate the income to pay for your services?
Sure.
Because if we lose this 40 to 50% of your workforce, and we will have that across the entire sectors. Yeah. We have it seen in cement and oil before. Where are we going to create the value?
Yeah, no, it's a great question. I mean, if no one's employed, then clearly that's not going to be good for any industry. The employment challenge that comes out of the transition from the old economy to the new economy is a very real issue that, and I don't have the simple answer to it. I think if you look at the balance of payments between the financial sector and the economies it serves, we're often described as rent seekers. The reality is that's what we do. Society says we want you to do the following things, and we do it as well as we can, and then there's a profit that we extract, and it's distributed back into society. One of the forces that we've already referenced today is price compression or margin compression coming out of new technology, providing more price transparency. So actually the cost of what we're doing, particularly in the retail space, is coming down. Asset margins are under pressure everywhere. Liability margins have been compressed, largely through central bank intervention. Disruptors are taking revenues away on the payment side, and so are regulators, and wealth management fees are coming down as well. So but there is already a shift in favor of the consumers. But your question is very valid. Will that shift be enough to cater for the employment disruption that will come, not just in financial services, but across all the economy? I don't know.
Well, there are clearly two theses out there on this topic. I mean, you have, on one hand, people that say that in 20 years there will be 50% of people which will be unemployed, and the other thesis is that this prediction has proven wrong over the centuries and will prove wrong once more. I am more on the second one, but I believe it poses a real challenge for our education systems, because we need to radically improve the quality of our education if we want to cope with that challenge.
Martin Blessing?
Yes, I don't see because you said 2025 that half of the population is unemployed by that, and in terms where we will generate as an industry our revenues, it will be pretty boring compared to today. It will be interest income and commissions, and yes, there is margin pressure. But if we go back, I think when I started my career in '89, I think we wrote papers about margin pressure and the need to change. So that is nothing new, and it will continue, and it will mean that you have to basically become more efficient and live with lower margins. And in the end, there will be probably also a little bit less providers, and those ones that manage this transition well will be still around. So I guess of those financial services companies that will be around in 10 years, we already know 80% today quite well, right?
Let's address one thing that I know has been rumbling on in the background of what we've been talking about implicitly, but it's mentioned explicitly, blockchain technology. John Flint, what exactly are you doing with blockchain technology as big banks? How significant an advent is it for you? Are you really embracing it to full potential or not?
Yeah, I think the application of blockchain or distributed ledger technology, there are significant applications for banks. You know, we look after other people's stuff in its broadest sense, largely non-physical assets now, and a distributed ledger is a new way of doing that, a cheaper way of doing that, and the applications there, I think, are very significant. The applications in the context of anonymous currencies, I think, have no future. Not in the mainstream anyway, because it is increasingly important that society expects the financial system to understand how money is being used and who's using it and for what purpose.
So will the Bitcoin die 1,000 deaths eventually?
It has found a role. It will continue to occupy a niche role, but I don't ever believe it will become, or any other anonymous currency will become mainstream.
Martin Blessing, what do you think?
I have no Bitcoins.
No Bitcoins, not interested. And Denis Duverne, do you think that Bitcoin will end up being a flash in the pan when eventually interest rate policies start to normalize around the world?
No, I don't believe in the anonymous currencies, as John was saying. I believe that blockchain will have applications for to develop new forms of contracts, and we are doing some experiments in that field already. It's very difficult to envisage the totality of what's going to happen, but we definitely believe it's a technology that we need to invest in and have invested in.
So invest in, but you won't be investing in too much, because parts of it, like for instance, Bitcoin and anonymous currencies, you don't necessarily believe in. Let's take two more questions from the audience before we have to wrap them up. If there's a lady in the front there with your hand. If you could just keep your hand raised until a microphone comes to you. Thanks.
Thank you. Deborah Henderson, Center for Inspired Leadership. So my question is obviously going to be on the radical cultural transformation. I'm curious what you find as the most challenging element as leaders of your organizations, and having given John in particular the outline of the buffer element that's kept the industry as it is, how do we address, or how do you address this issue almost from a systemic standpoint, because you've got trust that actually shows up for every institution, and once one shows any elements of distrust, it impacts all the others too. So I'm curious, it's a two-pronged question. How are you looking at it individually, and how might you look at it systemically?
Yeah, it's a great question. Look, I think when you look at how our industry got things wrong, and you try and understand what went wrong, what you don't find is you don't find large groups of people with bad intent working in banks who just decided one day to do dumb stuff. But you do find, you can find badly designed systems and processes designed at the top of the firms that then created an environment where people did do some silly things, either on trading floors or in retail networks and branches or in contact centers. So I think the focus is not, that the challenge is not to worry too much about the individual or collective psychology and behavior of distributed sales forces, because they're generally good people. In fact, they're wonderful people. The challenge is to keep the pressure on the top of the house, to keep making sure that the systems and processes, how you pay people, what you tell people it is you want them to do, and then the systems and processes that reinforce that, make sure they're not conflicting your people. Every bank says, we exist to serve our customers, and then some banks still have formulaic incentive schemes that conflict their staff the moment they walk into the bank every day. Things like that, and that's not a staff problem, that's a leadership problem. So I think the culture thing, for me, the challenge is to keep focusing at the top of the house, because that's where it either goes right or goes wrong.
Martin Blessing, would you agree?
I think, for me personally, I think the biggest challenge is to find the right balance between, pushing and inducing change, making change happen, but not do it too much so that people start to misbehave. Because that's what you normally see. If you put on too much pressure onto the system or too much incentive, then suddenly people try to go into a direction you don't want them. If you're basically not pushing enough, you're not transforming and changing fast enough. And finding the right balance, whether it's in the sales culture or in digital transformation, to not overshoot, but to be fast enough to stay alive. Finding this right balance, I think personally, is the biggest challenge.
And Monsieur Duverne, from a leadership point of view?
Well, I guess that's, you need to have strong values that are visible from the top. And for us, integrity and courage are two key words. We have 4 values. The other 2 are customer first and One AXA. So it's very simple message that goes through our staff. Having said that, within a large organization, it's quite complex, because you want at the same time to have rigorous processes, compliance, adherence to procedures, and so on. And at the same time, you want to generate the autonomy and decision-making capability that will make your organization reactive, agile, and that's a challenge that we are facing every day.
Right, as we wrap things up, let's just see whether we can have a reminder of the results of those 2 votes that I asked you to take a look at, if we can see whether we can see the results on the floor. You may remember that it was cultural transformation that was the biggest thing, business remodeling, but basically not many people thought that mergers and acquisitions was a big part. And then if it's possible to see the first question I was asking about adapting to change, no, maybe we can't see that. That was in the first panel, but you'll remember what our panelists said on that. Thank you very much, ladies and gentlemen, for persevering through both panels and some excellent points of view. I'd like to thank our panelists, John Flint from HSBC, Denis Duverne from AXA, and also Martin Blessing from UBS. Thank you very much for your time here today.